This video is grasping beta, understanding market volatility. So to kick this off, I'm going to tell two stories to try and explain beta. So the first one is me and some buddies in high school went down to Baltimore. One of my buddies his dad rented a sailboat. So we're cruising one day, we're boozing on the front of the sailboat, catching the wind. Everything's great. We're having a great time. And then the wind starts kicking up. All right. There's like gradual, but we all eventually reached a point where we're like holding on to something. The boat's like almost horizontal, and we're like, dude, if I let go, I'm probably gonna die. Like I'm for sure gonna fall off the boat. We're going real fast. And this is like a very unsafe situation. And then eventually, my buddy's dad came to the same conclusion. Was like, oh shit, like this escalated quickly, and then we slowed down and eventually everything was fine. So in that situation, right, with that boat, think about that boat as an investment. Think about the weather as market conditions. So a slight change in market conditions launch that boat, right? Huge impact on the boat, where if there's no wind, right, the boat's doing nothing. And if the wind changes a bit, high impact on the boat. So that would be a high beta, highly correlated with the weather. Same the way an investment would be highly correlated with the market ups and downs. So here's another story. Is when I was 25 in active duty on deployment, we were coming back from deployment on a ship. We're in the middle of a Pacific Ocean, and there was like the perfect storm type hurricane out at sea. It's like all we saw was like black clouds. There are these freaking huge waves. There's lightning, all sorts of crazy stuff. So we snuck out of our quarters. We weren't supposed to be outside because it was a little bit dangerous. The ship is like kind of going up and down. We're like hanging on the railings, and it was pretty cool. But when we were there, like we felt pretty safe still. We were on a big ship. Captain knew what he was doing. So even though the weather was insane, like, if you were on that sailboat, you were for sure dead. Like you'd have been for sure dead. But even though there's this massive storm, that ship was still pretty safe, right? So that storm didn't impact that ship all that much. So that would be a very low beta, where that type of investment, right, regardless of what's happening with the weather, it's still going to just do whatever it's going to do, right? It's not heavily correlated with market conditions. So I'm just going to do a quick technical thing, because you don't really need, like, if you're a institutional investor, they measure beta, right? It goes into like CAPM, and it's an important metric. You guys don't need to know that. I'm gonna cover it quickly, but then I'm gonna kind of talk about what you should be thinking about and why it's important. Okay. All right. So here's just a little chart. This is an easy way to just visualize beta. It's really just how is it changing with the market, right? So this purple line would be like the S&P. Typically, you measure beta against the S&P, because you want to understand that's what most people think about is like the US market. So, when the market's going up, a high beta investment goes higher, right? That's why, you hear people say like, oh, like small cap stocks are more risky than large cap stocks. Well, that's not really true. It's just they have a higher beta, right? So they're going to grow faster, but they're also going to decline faster, and you can see that in the numbers. That's why from like 2012 to like 2022, small cap stocks outperformed the S&P. They outperformed large cap stocks. Why is that? Because they have a higher beta, right? They're in an up market. They're going to have higher returns. But then guess what? 2022, small cap stocks are underperforming the large cap stocks. Why is that? Well, because it's a down market, right? So in a down market, a high beta is going to be lower than the market. Okay. So high beta just kind of means, it is going to do more than whatever the market is doing, but it's roughly correlated with the market. And a low beta means it's still correlated with the market, but it's not going to do as much. It doesn't, like a low beta is, it's not going up as much, and it's not going down as much. All right. So why is this important? So the first thing, man, I hope a lot of you didn't do this, but crypto, where a lot of people jumped on the crypto thing there. Everyone's like, oh man, this is going to be like some new technology, should buy these coins or whatever. It is just a high beta investment, guys. So, when all these like Gen Ys and Gen X's and even millennials, when we were getting these free checks, right, during COVID, and everyone was just living with their parents, right? You couldn't go outside. Well, what did people do? They put this free money into these bullshit assets, right? The crypto assets. So what did it do? It went up. So what are hedge funds going to do? What are institutional investors going to do? They're going to capitalize on that trend. So they put money into it as well. Then guess what? As soon as the market hit, as soon as the market started to turn, anyone who was smart knew that that wasn't actual value in the market. It was just beta. You were just capitalizing on the volatility of that asset. So they exited. And then guess what? When people sitting, in their parents' house saw, their crypto value start to decline, guess what? They sold theirs as well. So I hope a lot of you didn't jump on that crypto train, but now it's pretty much back down. But so just be really careful about that, guys. You don't want to, if you are not an institutional investor, and if you're watching this video, you're not, right? You probably don't do this professionally. Don't buy assets highly correlated to beta. All right. Because for you to win there, you need to be like the first person to know. It's the only people that are going to have a chance are like the market predictors. It's going to be like the Bridgewaters and these firms with a high track record of success who have billion-dollar algorithms analyzing market conditions and who know everyone, right? So for you to win in highly assets with high beta, you basically have to be completely dedicated to tracking the market, which you are not going to be, right? So when you think about that, what a high beta asset is, it's pretty much going to be anything that's not rooted in physical assets, right? So like crypto's nothing. You want to take a look, even like a stock that is essentially, you're investing in a company. But individual stocks, like we also know, also have high beta. You have to be like super tied in to understanding the market and those specific stocks. So I don't recommend anything other than index funds. So that should be the highest beta asset you have, is an index fund, right? And that's typically what people benchmark against. So like the S&P index is, you're not going to have beta because that's what you typically index against, but I don't recommend you do anything more than that. So don't pick stocks, don't buy crypto, don't do anything that's not rooted in hard assets. So now real estate, specifically rental real estate, when you're valuing based on the cash distributions you're going to receive, that's extremely low beta, right? Basic, to an extent, as long as you're not doing stupid things, it is not going to be impacted by market conditions. It's like my properties for the last 7 years, I get a rent check every month. It's like, now the value of the home changes with the market, but I don't really give a shit about that. I care about what cash distributions I'm receiving. Right now, there's a time and place to refinance. That's kind of a different thing. But as an asset valued based on the cash that is being distributed, there's almost no correlation to the market as long as you're not doing stupid things. Like obviously, don't buy in like risky places that have a risk of, the whole area kind of like going down the crapper, and then people lose their jobs and stuff. So be careful about that. So to recap, don't recommend you buy crypto or individual stocks. Those are high beta. Be really careful if you are going to invest in real estate. I was around a lot of guys who are just like throwing money at multifamily in the peak of the inflationary environment. In a lot of those deals are just not going to work, because what happens in multifamily, it does get valued based off the rents. All right. But a lot of times you're going to get like a 5 or 7 year debt service or 5 to 7 year commercial loan on that property. So there's kind of two issues with multifamily. One, it was overbuilt generally. So the rent growth is probably going to be lower than what people were projecting. And then also with interest rates, that commercial bank is going to come in and they have to revalue how much they can loan based on the new interest rate when that's up. So in a lot of situations, that value is going to be, half of what it was in some instances. And there's not going to be enough equity in that deal to actually be able to continue to afford that asset. So people are just going to lose their assets. So I would be really careful about like this multifamily craze. Most of what we're investing in are either, a portfolio of residential homes with no debt, right? So super, super low risk. Or we're looking at recession-proof real estate, so mobile home parks, or we're looking at businesses that are not going to be correlated with the market. So we just invested in a cannabis company. So these are kind of like alternative opportunities that are off the main beaten path. And then the only other thing, guys, is if any of you are thinking about a real estate course, talk to me first, man. It's like, it's free. I do this for free. It's just like, there's so much bullshit out there. I talked about this in the last video, but a lot of the people that think they know what they're doing in real estate, it was really just beta, right? They made money. Yeah, that's great. But it was just because we've been in an inflationary environment for the last 10 years, right? They're not actually producing alpha. They're not producing actual value. They kind of just like capitalized on the situation where we had, QE since 2008. The Fed was just pumping liquidity into the system, and that's just going to translate to increased values, increase rents, increase everything. But their operational models are trash, and they don't work in situations in a down market. And I'll tell you one more quick story is, I'm tied into some groups that do flips out here in San Diego. So I remember in like mid 2021, it was right before COVID hit, like the peak of the market. I remember seeing a post. It was this group, it's a group of 4 people. And it was like, we just flipped this thing for 800K. It was a 6-month project, like this big like accolade piece of, how great they did. And sorry, it was 800K. And I'm looking at that. I'm like, shit, dude, like maybe I should get into flipping, right? Like 800K sounds pretty good. But then I did the math. I was like, all right, there's 4 people. So maybe 200K a piece, minus fees, minus taxes, 30%, whatever. So maybe like, I don't know, 100, 150K each of them made over the course of 6 months. I looked at my house, right? I looked at the house that I owned over the course of those 6 months. It appreciated more than that. It appreciated like 150K. So meaning, right? That's great. They made 800K. I made more than every single one of those people doing nothing, right? So that's not always going to happen. But the point is their operational model has negative profit margin, right? Where if that was a static environment, if prices weren't going through the roof, they would have lost money on that deal, right? And those people are out there, they're teaching stuff, they're writing books, they're going to seminars, because nobody does this stuff. You know what I mean? No one is tracking beta. No one's benchmarking what people are actually making relative to just the market. Nobody's doing this stuff. So that's why I'm doing these videos. So anyways, guys, if you're thinking about a course or something like that, talk to me first. And I'm happy to give you a second opinion. Yeah, I hope that was helpful. If you have comments or questions, I would love to hear them.